Hello everyone and welcome to our webinar on the voluntary carbon market. I'm here with our Head of Climate Advisory Specialists at Responsibility, Satish Dhanapal, and Carbon Market Specialist at Climate Focus, Szymon Mikolajczyk. Before I hand over to the experts, let me introduce you to the housekeeping information. As you may have all noticed, you're currently muted, so if you have any questions, please type them into the right-hand side bar, and we'll answer them towards the end of the session. A few words on responsibility. We are a leading impact asset manager specializing in private market investments across 3 different investment themes: financial inclusion, climate finance, and sustainable food. We manage almost $5 billion in assets across 280 portfolio companies in 75 countries. And now over to you, Satish and Szymon.
Thank you, Fran. Good morning, good afternoon, everyone. Thank you for taking out your time for joining this webinar. I'm Satish Dhanapal. I am heading a global climate advisory specialist team within Responsibility. I've been with Responsibility for 7 years. So I started my career with the carbon markets work for a Singapore-based carbon management company, and I have close to 15 years of climate-related work in this field. And I initially started developing projects for various developers, and then moved on to corporate strategy, and then supported various governments, and then within Responsibility supporting all our climate funds. So here with me, we have Szymon from Climate Focus. Over to you, Szymon, if you could do a quick introduction.
Thank you, Satish. My name is Szymon Mikolajczyk. I'm a lead consultant at Climate Focus. And Climate Focus is an international advisory firm focusing on climate change policy, international climate finance, and carbon markets. I have been working in carbon markets for the past 15 years, initially starting off in the Kyoto Protocol's compliance markets, and then moving into the voluntary carbon market space, where I've been helping investors and project developers with sourcing investment opportunities, due diligence, procurement strategies, and any other strategic considerations around operating in the voluntary carbon market. So very much looking forward to today's discussion. And with that, I'll hand it back over to you, Satish.
Yeah, thank you, Szymon. So before we dive into the presentation from Szymon, so we'd like to also understand the participation group. So we have a poll, so you'll see the poll in the screen. So if you can select one which represents your background, so it'll help us to understand the group which is participating in this webinar. Maybe we take 10 seconds to have this poll. And once it is ready, then we can also see the, okay, interesting. So we have a lot of our financial institution partners here, DFIs, and also there's other outside participants also interested in this topic. Great to know this. So over to you, Szymon, on this topic.
Thank you, Satish. And I will just wait for the slide deck. Perfect. Well, warm welcome again to all of you. Great to see so many participants today. And as already introduced by Satish, we will be discussing the state and trends of the voluntary carbon market. And before diving into the details and specifics around transaction risks and opportunities, I would like to start with some definitions and some general overview of what has been happening in the carbon market and why we are talking about this today. So on the next slide, just a depiction of the basics of a carbon market and how a carbon market functions. So in a nutshell, a carbon market is a trading system that allows buyers, which could be individuals, companies, or countries, to claim or to purchase claims to emission reductions, which are generated by sellers. And sellers use the carbon market to monetize these emission reductions and use the resulting carbon finance revenues to fund their operations and scale their project activities going forward. Now, the reason why buyers are interested in engaging in the carbon market can be twofold. So the first main pillar of demand is the voluntary corporate commitments that could be either on a company level, could have a carbon or climate neutrality commitment, or a product or service level, as well as corporate net zero strategies, which also in part allow for the use of certain types of carbon credits. On the other hand, you have compliance-driven demand, where you have, for instance, emissions trading schemes or carbon tax schemes, which in part allow covered entities to use voluntary carbon credits to meet compliance obligations. Today we'll be focusing on the voluntary segment. And on the next slide, please, just to maybe put this discussion also into the broader context why we are talking about carbon markets. This is an illustration from the latest UNEP emissions gap report, which essentially shows us the projections on the basis of all the country climate commitments submitted under the UNFCCC following the Paris Agreement. And in this middle red line, you can actually see where the current levels of ambition get us in terms of decarbonizing the global economy. And it actually is not getting us very far. So as you can see, it kind of allows us to plateau and reach the same level of emissions by 2030 as we have today, and gets us on track of above the 2-degree target, closer to 2.5 as a matter of fact. So to get on track to 1.5, and that's what you see at the bottom of this graphic, there is a big gap that we foresee, which is essentially around half of global emissions, which we are not tackling on the current national commitment. So this is really an opportunity for the carbon market as a whole to make a difference, because it's really based around on tapping the most cost-effective abatement opportunities, and that is just a huge opportunity that we can all use to go beyond current climate commitments and try to get as close as possible to the 1.5-degree trajectory as per the Paris Agreement goals. Next slide, please. Here we see that that the historical issuance volumes within the voluntary carbon market, and the voluntary carbon market here depicted in this dark purple segment, is composed of a number of independent certifying bodies, or carbon standards as they're known, which certify emission reductions and issue carbon credits. So there are a number of registries which are behind the issuance volumes that you see depicted here. Some of you might be familiar with Verra's VCS or the gold standard. These are the two largest voluntary carbon standards out there. But there's a number of other standards, and the list goes beyond the standards also shown here. As you can see, the market has really been picking up since around 2018, 2019. With the market tripling in the past years and reaching a total capitalization of $2 billion. So, you know, in the grand scheme of things, comparing this to other commodity markets, still very nascent and very small, but showing a lot of interest and a lot of growth. And I think this is also why we are discussing this today, because there is a lot of investor interest in how carbon finance can be used to generate additional revenues for climate change mitigation activities. Next slide, please. Carbon credits in the voluntary carbon market can be generated by a wide array of activities. And here you can see depicted the main project types, which are certified by these various carbon standards that are out there. The largest category is renewable energy, which can include anything from wind power, solar, hydropower, and both large and small scale installations, as well as nature-based activities in the forestry sector, and specifically in the conservation of existing rainforests and other types of ecosystems. So together, these first two categories account for around 2/3 of all issued carbon credits to date. Then there are other large areas as well, such as clean cooking, clean or improved cooking, as well as methane avoidance from waste activities and carbon sequestration from nature-based projects. So this could be reforestation or climate-smart agriculture and soil programs. Next slide, please. The coverage of the market is global. As you can see here depicted is top 10 countries in terms of aggregate issuance over the last year. So this is only looking at 2022 issuance volumes in the voluntary carbon space, and highlighting the top 10 issuers. As you can see, it's dominated by global south countries, with the exception of the United States, which has a very strong compliance market linked to the voluntary carbon market as well. So this is generating demand. But other than that, you see leading countries such as the DRC, China, a number of Latin American countries, and a lot of these volumes, especially issued last year, relate to nature-based projects around forest conservation and reforestation. And these top 10 countries are responsible for 85% of global issuances. Next slide, please. So when looking at potentially engaging in carbon markets and evaluating the business case for carbon project development, there are a number of considerations that from an investor or project development perspective are important to account for. We will run through these in detail now in the coming slides, but these include certification. So to start with, is my project eligible for registration under one of the available carbon standards? If so, how many carbon credits can I expect to generate under my activity? And when will I actually be able to monetize the carbon credits? So actually I start benefiting from these carbon cash flows. Next is pricing. So once I actually am able to generate the carbon credits, what are my routes to market? What are the main sources of demand? Where are they coming from? And what are the prices of carbon credits, both today as well as looking into the future? And finally, policy considerations, which are especially relevant today in the context of the Paris Agreement, where both developed and developing countries have emission reduction targets. This has implications on how the government positions itself towards authorizing or regulating voluntary carbon market transactions. But it also, on the other hand, can present opportunities because it can open up new routes to market. And with that, we'll move into the first segment on certification. And in the next slide here, just to summarize the key eligibility criteria for carbon projects. And this is a high-level view, so in the end, the eligibility criteria are project specific and will depend on the standard. But if you look across the different standards out there, these are really the key pillars against which projects are assessed. Starting with additionality, this is a very important criterion which stipulates that a project is eligible for carbon financing only if it can evidence that it really requires that financing to unlock investment and be implemented in the first place. So if your project is already kind of a business as usual activity, it would unlikely qualify for certification under the current standards. The second one, of course, using approved methodologies by carbon standards that ensure that there is a conservative estimate of the emission reductions that in the end represent the volume of carbon credits that are being issued. So here we look at baseline emissions, which define the business as usual emissions, and then you compare it against project emissions and any potential leakage emissions associated with your project. Next is permanence. So ensuring that the emission reductions or removals that are implemented or realized are also permanent, and there's no risk that in a few years' time, for instance, the forest that you have replanted will be deforested again, resulting in these emissions being released. Stakeholder consent, so various degrees to which stakeholders need to be consulted depending on the standard, with some of them depending on the project categories as well. Requiring free, prior, and informed consent from local communities, and finally restrictions around no double counting. So essentially making sure that there's no double crediting occurring from projects that might have overlapping project boundaries. And all these criteria on the next slide you will see are evaluated. Move to the next slide, please. By both a third-party auditor and the standard itself. So this is a schematic that shows the project cycle, starting initially on the left-hand side with preparatory work by the project developer or investor, potentially supported by a consultant, which is all about evidencing that these previous criteria I explained are really met by your project. And then it goes into a third-party audit or validation system process, finally ending with a registration and approval by the carbon standard. So this is a process that can take a year, sometimes more, depending on the project type and location, and cost anywhere between $50,000 to $100,000. Again, this is just a high-level estimate, but you can already see that it is quite investment heavy at the start, especially considering that carbon cash flows generally only come ex post, so once they are generated and verified. And this is what the second part of the slide shows, which is a recurring impact monitoring process, whereby once there is a year, for instance, of implementation, you have to evidence that you have generated certain volumes of emission reductions, have that third-party verification or audit as well, and then finally the issuance of the carbon credits by the governing standard. So this is a process that generally also takes 3 to 6 months and can cost up to $30,000 per round. Next slide, please. So some considerations for investors and project developers, specifically relating to the certification part. First of all, that carbon standards may restrict eligibility criteria around certain project types. We have, for instance, seen 2-3 years ago that the major standards, Gold Standard and Verra, have introduced restrictions around large-scale renewable energy projects, which are now only allowed to be certified in least developed countries. Carbon standards may also adapt their additionality criteria and how they assess and determine what is, for instance, common practice versus what still can qualify for carbon finance support. And carbon standards, and this is a topic that's becoming increasingly more relevant today, are becoming more conservative and attentive to how emission reductions and carbon credit volumes are actually accounted for. So these could result in current methodologies becoming more conservative in the future and resulting in lower volumes of carbon credits as a result. On the other side, there are developments that facilitate and reduce the cost to markets, such as digitalization of monitoring, as well as more standardized processes within these carbon standards to really more quickly move through the certification process, and new methodologies being developed and introduced, which allow new project types to enter the market as well. And with that, we'll move to the pricing part, which is all around, once you have managed to go through the process and have issued carbon credits, what are the prospects for transacting and monetizing them? As mentioned at the very start, there are two principal areas of demand for voluntary carbon credits. The primary source of demand is corporate voluntary demand, which is triggered by carbon or climate neutrality claims or corporate net zero commitments. And the second one is the compliance demand, which is driven by domestic carbon pricing schemes that in part allow for use of voluntary carbon credits, or sectoral compliance scheme like the aviation sector's CORSIA scheme. And while the corporate compliance demand really looks at this from an accounting perspective, so less towards the different attributes of projects, but more whether they just meet general eligibility criteria and can be used. In the voluntary context, the different project attributes and characteristics are very important and relevant when valuing carbon assets. And in the next slide, you will see some of these important evaluation criteria that buyers use. So on the one hand, what type of project is it? Is it, for instance, a nature-based project or a renewable energy project? And the market also makes a differentiation between projects that avoid emissions in the future versus ones that sequester carbon, such as reforestation projects. The type of standard that is applied, because there are different levels of integrity and reputation associated with the different standards out there, the location of the project, whether it comes from a more exotic location which provides additional value to a buyer, or comes from a large supplier country. And then of course the actual transaction terms. Sometimes there might be prepayments which might impact the valuation of the credits over long term, as well as looking beyond the climate benefit and looking at the co-benefits and SDG benefits that projects contribute to. And because of these different factors and different projects and different standards, in the next slide you will see that the market has been pricing carbon assets quite differently depending on the project type. And here you can see a historical overview of how carbon prices in the voluntary space have been developing, with the dark black line representing the average price, and the dotted ones, well, project categories, so anything from renewable energy in red, which comes out kind of at the bottom, through to community-based cook stove projects or domestic biogas projects in orange, methane avoidance in yellow, and then different types of nature-based projects. So red is conservation of standing forest, and AR represents afforestation and reforestation, so planting new forests. And you can see that especially the nature-based projects and also the community-based projects really transacted a premium over, for instance, large-scale renewable energy projects. And another takeaway from this is that there's been along with the issuances going up as previously introduced, the prices have also been rising quite rapidly, for many categories, more than doubling between 2019 and 2022. And right now we're in a moment of pricing consolidation, and in the next slide you will see the most recent pricing based on kind of standardized spot contracts which are available to buyers if they don't want to actually purchase into unique kind of bespoke projects, but they are happy with a standardized carbon credit. Then there are a number of exchanges that deliver kind of day-to-day pricing, and here you can see the as of May the prices for carbon credits, so anywhere from $2 per ton for a renewable energy project to $13 for a nature-based removal project. Next slide, please. So some considerations again for investors and project developers around pricing. So one very relevant one in today's market, that increased reputational concerns around the environmental integrity. So essentially the GHG accounting part associated with certain carbon credits coming from projects can really impact pricing. So those that that are associated with questionable accounting practices are discounted, and those that are backed by robust methodologies are demanded for in the market. There can be scenarios where companies move away from certain claims, such as carbon or climate neutrality, which is slowly taking place, but are being changed by net zero corporate strategies. These are having impacts on the type of carbon credits that are being demanded for, as well as host country restrictions on exports of voluntary emission reductions, which will be treated more in more detail in the last section on climate change policy risk. There are also opportunities in terms of further integration in domestic compliance schemes. So again, compliance demand for voluntary carbon credits right now is secondary, but as countries introduce emissions trading schemes or carbon tax schemes, they often allow for linkage to domestically generated carbon credits, as well as in the context of the Paris Agreement, transition to new market mechanisms and sources of demand that this new climate regime brings. And in the final section, we will look at the climate policy risk. We can move to the next couple of slides. Thank you. So the Paris Agreement introduces new market mechanisms, new carbon market mechanisms, and these are mentioned on the Article 6 of the Paris Agreement, and hence have been called Article 6 market mechanisms. And not to overcomplicate this story here, but essentially because countries now, both developed and developing countries under the Paris Agreement, have emission reduction targets, there is a different value being attributed to domestically generated emission reductions by developing countries. Under the Kyoto Protocol, they could export carbon credits and that didn't have any impact on national GHG accounting practices, but under the Paris Agreement it does, because any carbon credit that leaves a jurisdiction needs to be accounted for. And this is where policy risks come up, because countries may take different positions with regards to how do they treat the voluntary carbon market transactions. Do they authorize them? Because if they're authorized, then they need to be accounted for. If they're authorized, then there are different routes to market, because they can be used, for instance, by other compliance countries under the Paris Agreement, or sectoral demand coming, for instance, from CORSIA, being this aviation scheme. And if they're not authorized, this could be more left to either domestic demand or, for instance, the voluntary carbon market. And in the next and final slide, just some considerations around the policy risks. So again, one, that host countries could decide to entirely block the export of carbon credits coming from projects. Could be from certain type of projects, or could be just a blanket all approach. This has not yet been happening, but there are already certain indications that countries are at least temporarily blocking the export to evaluate how they should actually regulate the market. What is happening already is that host countries are introducing different types of taxes or levies on the revenues coming from carbon credit sales, or imposing revenue sharing obligations. So for instance, that a certain share of carbon revenues in the future needs to be shared with local communities. On the upside, there are also opportunities that the Paris Agreement and these new market mechanisms bring. So on the one hand, it is expected that projects that are actually vetted or authorized by governments, so this is called correspondingly adjusted for, would transact at a premium, so then being beneficial for the project developer and investor. As well as the Article 6 market opening up new routes to market. So as mentioned earlier, for instance, sectoral demand from the aviation sector, or governments that are looking to purchase Article 6 units for compliance reasons. And with this we have come to the end of the presentation, and I look forward to a discussion and answering any questions you may have. And thank you for your attention. Over to you, Satish.
Thank you, Simon. Thanks for this very interesting presentation. So before we move on to the Q&A, so we'd like to also understand from the participants. So we have this poll. So we've looked at multiple topics. So how far you are aware of these topics? So if you can poll here, or give your vote in terms of which topics are more familiar to you, or which one is new to you. Good, we are getting the results. Okay. So countries dominating the credit supplies is a new topic, and issuance categories. Good. So we'll cover some of these in our Q&A also. So Simon, thanks a lot. So carbon credits is not just for large developers. So even small holders could also benefit from this process. So can you please throw light, because since we have a huge group of financial institutions joining this webinar, so my questions are more aligned towards their perspective, financial institution perspective, when they lend to these projects. So what should be the minimum scale? Even a EV owner, small EV owner, or a small agriculture smallholder doing climate smart agriculture practices, can they also look at carbon credits as a process? So what should be the minimum scale people could look at for getting into this carbon credit process, and also throw a bit of light on this programmatic approach as well?
Yes, sure. I mean, the programmatic approach that you mentioned is indeed a key development that has allowed smaller, kind of more decentralized emission reduction activities to benefit from the carbon market. Earlier, especially under the Kyoto Protocol and the Clean Development Mechanism, which was a compliance carbon market under the Kyoto Protocol, we saw the trend that mostly large-scale investments were getting access to the carbon market. So that was in part due to the fact that there are these large upfront costs associated with developing a project, and also that there were just restrictions on how you could expand existing projects, especially if you don't know how large they could be from the onset. Then around 2010, this programmatic approach was introduced, programs of activities, which essentially is a concept that allows project developers to start small and then over time expand their project. And while you can in principle also use that basis to expand, for instance, certain medium-sized renewable energy capacities, in general, this programmatic approach has been used by implementers of clean cooking projects, domestic biogas projects, safe clean water programs, as well as climate smart agriculture, whereby essentially project developers can pool small volumes of emission reductions under the umbrella of this programmatic approach. That has been very successful in unlocking investments, especially in the clean cooking space. So both improved and clean cook stoves and domestic biogas, and around 15 to 20% of all carbon credits issued these days come from these activities, and they essentially all come under this programmatic approach. So this really gives flexibility to project developers to include individual installations or even individual households and communities into these programs. And essentially the basis for the transaction is that an individual household or a community signs off on an agreement where they actually hand over the claims for the generated emission reductions to the project developer, and in exchange they receive either a subsidized device, be it a cook stove or a biogas, or entirely handed out for free, and they just commit to taking part in these annual monitoring efforts. And then essentially there might also be some sort of revenue sharing agreements between communities and projects as well. So that has really opened up the space for these project developers that are able to aggregate at individual households or smaller installations into bigger programs, and thereby reducing the barrier to entry for smaller projects.
Okay, great. So the key in emerging markets is to find a right aggregator who can aggregate these small projects to kind of develop a programmatic approach. So as a financial institution, we should be looking out for an aggregator who can do this task of aggregating all these small projects. But when it comes to scale, so even a small projects could also get into this carbon credit process. Great. And Simon, you also mentioned about upfront cost, and while it looks like a lengthy process, so how do you see, so which part of the process is very complex and it takes more time, effort, and cost, because there is a validation registration process, and then there is a verification and issuance process. So how do you see from your perspective which part is more heavy lifting from the project developer perspective?
Yes, so I think both from a project developer but also from an investor perspective, the higher risks are naturally at the earlier development stages of the project. So when we kind of differentiate between the registration process and what happens thereafter, typically it is the validation registration steps that take time, are resource intensive, and well, essentially still carry the risk that the project might be deemed non-eligible. So you could invest upfront resources and then not be able to have certified carbon credits at the end of the day. And that's why this initial pre-screening feasibility stage, which is usually a fairly quick process to screen a project against eligibility criteria of a carbon standard, is so important, because then you avoid this risk that you actually invest a lot of capital and at the end of the day you get rejected from participating in the market. So I would definitely say that getting through the validation and then finally registration hoop is the key barrier to overcome, because once you are registered, essentially that means that the carbon standard has vetted your approach and deemed your project to be eligible. So you then have to operate typically for a year before you can commence your first verification phase of realized emission reductions. Typically there's also, of course, risks there, because the first time that you're actually monitoring, and there might be issues with what you've monitored and how you've monitored and how you've actually implemented a monitoring plan. And especially once you actually overcome that first issuance, then going forward there is already a precedent. So generally speaking, from an investment perspective, projects that have issued once are at the lowest risks. Then the projects that have registered but not yet issued come second, and pre-registration projects are the highest risk because we don't know yet whether they'll be able to access carbon finance in the future.
Okay, and this is a phase where most of the cost also goes in, and it's heavy lifting from the work as well as from the investment, right?
Exactly. So I would say at least 2/3, if not more, of the costs are associated with this initial upfront phase, because before you get to validation, you also have to conduct baseline surveys. You might have to conduct detailed stakeholder consultation procedures, look at co-benefits. So that there are a number of steps you have to go through before you can submit your application to a third-party auditor, and based on the positive validation outcome, the carbon standard, evaluates that. So it's a lengthy process, and yeah, generally takes a year. So it has to be accounted for in terms of timing, unless of course there are structures whereby project developers receive upfront finance from buyers, and that's an interesting opportunity, because then rather than putting the upfront finance themselves, they can benefit from upfront finance from an investor, and of course in return for that, offer future carbon credits at a discount to this buyer or investor.
Yeah, that's good. So aggregators or project developers who are struggling with affordability of this initial process could also look at locking in a buyer at the early stage. So though the price they will get at a slightly lesser, but still that will ensure that the initial cost is being taken care by the buyers, and there is some certainty around the process.
Yeah, in a way you transfer some of that development risk to the buyer, and in return you provide a more attractive pricing into the future. But the other benefit from a project developer's perspective is that often you can then secure long-term offtake agreements from an investor or a buyer, corporate and buyer, which also gives the project developer kind of cash flow certainty, which is of course very much valued here.
Okay, and I think this project development, we looked at various risks in the project development, but there is also this external factors which also impacts these carbon credit projects, which is this host country requirements. And this changing government regulation is one of the key risks, especially recently we have seen few countries, and especially the latest one is Zimbabwe, where the countries also keep changing their requirements or the approval process for carbon credits. So how do you see this changing regulations impacting project developers in various emerging markets?
Yeah, it's very good and relevant question indeed. I'll maybe start by saying that countries are not necessarily changing rules. I think carbon markets, the voluntary carbon market, has thus far just not been regulated. So it's been operated by independent standards like the gold standard and Verra. And especially because in the context of the Kyoto Protocol, developing countries didn't have any emission reduction targets. The voluntary carbon market was free to essentially export credits, independent of the sector and the jurisdiction. With the onset of the Paris Agreement and countries starting to look into their nationally determined contributions and what do they have to bring in to achieve their targets, any emission reduction that is generated and is potentially being exported comes at a value. And if countries are essentially not looking into this, they run the risk that it will be much more difficult for them to meet their emission reduction targets, because all the low-hanging fruit, the low abatement opportunities will be exported out of the countries, and countries will be left with the higher abatement, more difficult kind of climate change mitigation options. So it is not unexpected that countries are coming up with frameworks that look to regulate this. There's of course then the debate how countries approach this, and whether to what extent are project developers and investors part of these discussions, versus to what extent are decisions just being imposed without any pre-announcements that have serious consequences on the viability of investments in the first place. And I think what we've been seeing, for instance, in the case of Zimbabwe, that these announcements are not helping investor confidence, because they come unannounced, and they have a very material impact on the investment viability of carbon projects. So I think it's a bit of a nuanced discussion, because on the one hand, in the end, it is the right of host countries to start looking closer and valuing carbon credits that are being exported. On the other hand, if countries actually want the investment to come to their country versus other countries which might be more open for carbon trade, yeah, they need to be careful on how and what they impose, not to scare investors away.
Okay, that's great. And as a lender to these projects, if you have to lend to project developers operating in some countries where there is expected or unexpected, it's difficult to predict these regulations changes. But how do you see this NDCs? Because each country have their NDCs, and so how NDCs are related to these voluntary carbon credits?
Right. So a lot of discussion on this topic as well. Essentially, you have different types of NDCs, and you have different also views on how the different market mechanisms under the Paris Agreement and the voluntary carbon markets will interact. But in principle, you could take the view that activities which are not included in the country's commitment could be for reasons that maybe they are very small or they're not accounted for because there's no kind of greenhouse gas inventorization of that sector, are at a lower risk because they're not actually being accounted for in the first place. So the government might be more willing to focus on the big sectors that is actually already part of the NDC commitment. But of course, many countries just have economy-wide commitments and no specific sectoral targets. And in that sense, then it becomes more of a discussion on rather than completely banning the export of credits from a certain sector, there likely will be certain either revenue sharing agreements or volume sharing agreements, whereby a share of the volumes would be for developers or investors to claim, and another share for host country governments to use for their own accounting. So I think we will still need to see, especially because the implementation of Article 6 and authorizations of voluntary carbon projects is still not fully clear. But in the coming 2 to 3 years, we will have more clarity, as well as in then what positions host countries will take. I think host countries will closely look at investor reactions and project development trends of countries which are more restrictive, and then judge whether they want to follow the same route or whether they want to, in a way, be more accommodative to investors, especially in certain sectors which might be difficult to otherwise attract investment into.
Sure. One follow-on question on this topic, right? So, as a financial institution, so I think there are various risks that to look for in this whole process, but this government regulation could also be a key risk when it comes to the amount of revenue that project could generate. So if a bank or financial institution has to lend to a project where the revenue flows through these carbon credits, so what should be their key focus, right? What should be the discounting they should do? Because either the carbon credits should be a comforting factor for these projects, or it should be the key revenue stream. Then what should be their focus there, and how they should look at for these kind of revenue risk?
I think that really depends on the project's finances and revenue streams, and to what extent there is a diversified revenue stream versus a project that's entirely built on carbon finance. If a project is entirely built around carbon financing and operates in a country which doesn't have yet defined rules about how it will regulate or potentially tax carbon transactions, there's actually a risk outstanding because the rules are still to be made, and in the end they will be host country specific. And as we can see so far, the regulations that have been coming out have been less restrictive than, for instance, Zimbabwe's case. But I think it does just signal to investors in countries that do not have clear frameworks yet that even there is no framework, it's investing in projects that are fully dependent on carbon finance creates a lot of exposure. So even in a situation where you have a buyer that has offered a fixed price for many years to come, if governments can actually nullify those agreements, then in the end, those future carbon revenues that seemed certain will become either unattainable or at least just in part realizable. So looking for governments that are signaling that they are open for voluntary carbon market transactions and already are implementing certain rules and guidelines which provide clarity to investors. I think this is the case in any type of investment, really. Reduces the risk, and then if there are projects that use carbon finance in part rather than fully, that also alleviates the risk that you'll be completely cut off from your the one and only cash flow that you have.
Great. No, this is a great point for institutions in specific markets. Look out for the host countries' guidelines on these carbon markets. It's very important because definitely it's a potential risk that could impact the revenue generation from these projects. So Szymon, before we hand over the stage to participants to share their questions, so one classic question which comes on top of everyone's mind when we talk about voluntary carbon credits is the recent articles around South Pole and Vera. So if you can throw some lights on your perspective on these articles.
Sure. So I think we need to keep in mind that the voluntary carbon market, as the name alludes, is based around primarily voluntary commitments and companies buying carbon credits because they use them for voluntary net zero or carbon neutrality claims. So the whole market is based around trust, and the moment that the trust is broken, then companies start thinking twice about making investments against claims that then will be heavily scrutinized by external stakeholders. And what's been happening in the case of some of the methodologies, you mentioned Vera as one of the standards that has been linked to some of these methodologies that have allowed project developers to over-issue credits. So essentially, they are calculating emission reductions against a baseline which is not conservative, and as a result, generating a higher volume of emission reductions and carbon credits than they should be. That becomes an issue, of course, because then these companies use each carbon credit to reduce a real ton of CO2 equivalent that has been generated by them. And the issue has really started around forestry methodologies and specific ways of how baselines are set for forest conservation projects. So these are called REDD+ projects. And how do you actually define what future trends of deforestation will be in a specific area or jurisdiction? That's based around modeling and assumptions impact really the baseline that you project into the future and the total volume of carbon credits that you can get out of the projects. And there have been newspaper investigations and reports around the risk that some of these projects are being overcompensated and generating volumes of carbon credits that significantly exceed what actually in reality they are reducing. So that has a trickle-down effect, because even though this might be connected to one specific project, it already indicates that a certain methodology has a reputational risk. So buyers move away from that methodology, they might move away from the entire sector, and you really see the prices react to that, with, for instance, forestry conservation prices really plummeting after the Vera and later project developer specific news coverage coming out. This is now, for instance, also expanding into the clean cooking space, and there's this kind of increased level of scrutiny around environmental integrity, which is very much necessary, of course, to really ensure that the trust in the market stays and is further strengthened, so the market can scale and then deliver the impact that it's supposed to deliver.
No, I think that's great. Currently, what happened is really helping the market, right? So it helps the market to strengthen the approach towards these projects. So, and also for us, from when we look at from financial institutions' point of view, definitely it helps in having more rigorous process of validating and certifying these projects. Great, thanks a lot, Szymon. So we will hand over the panel to Anton, who is our part of our climate finance team, who will help us in getting the questions from the participants. Over to you, Anton.
Thanks a lot, Szymon, for the insights, and Satish. Actually, we have quite some questions, so not sure we will be able to answer all of them. But the first one would be directly related to what we just spoke about, and it is maybe for Simon, this one. What is the outlook on debt financing and private equity investments for large-scale avoided deforestation projects? Is it expected to remain the same or to slow down?
I think looking what happened to the price and the general reputational concern around the sector, I think it's fair to say that investors won't be jumping into this space, right now until these uncertainties and reputational issues around methodologies are dealt with. They are being dealt with. So Vera is working on improving, or has been already working for some time on improving these methodologies. So I think it's like Satish mentioned, just really rebuilding the trust in that particular market segment. So obviously, I mean, it does bring valuations down, and at a certain point with project developers or investors having a longer term outlook, it may offer opportunities for investment, but prices for projects operating in the space have dropped by some 70%, and I mean this is kind of just an average, and then there are specific valuations for specific projects, but it has been quite a big hit to this segment. So I think it it just serves as a caution to project developers when they look at projects, not to to really evaluate what project developers share with them, and to what extent there is a reputational risk associated with some of the claims, because that, if it's not apparent today, it might come out tomorrow, and then you're you're facing the same issue.
Thank you. And then next one, maybe for Satish. Someone is asking, as a financial institution investing into carbon projects, could we claim the carbon credits generated? And if yes, how can we do so?
So I think that is from a credit claim point of view. Again, there is different approaches people have. So it depends on what framework and what approach they do. But for us, when we are still exploring opportunities to lend to projects which are generating carbon credits. So for us, we have a clear methodologies that we can account for CO2 generated from those projects where there is a carbon credit claim by some buyers. So that from our perspective, we make it clear that those projects, we can still lend to those projects because the project is creating impact, but we won't be accounting for the CO2 emissions through our funding.
Thank you. And then maybe another question for Simon. How difficult, as a project developer, how difficult is it to reach this additionality criterion?
Here, it will depend on the project type and also the standard that is being pursued. There are, for certain project categories like clean cooking or domestic biogas, kind of these more decentralized, smaller scale technologies, there is a concept that's called automatic additionality. So actually, if you just meet certain criteria around kind of thermal capacity and size, you're automatically deemed additional. So you don't have to actually go through what you otherwise would have to do is, for instance, a financial modeling exercise where you evidence that, well, my project without carbon finance generates IRR of 10%, investors need 15%, and with future carbon finance flows, I can actually get 16, 17%. That is the more kind of, a full cycle of evidencing additionality, which was more common for kind of, standalone renewable energy investment. So, and then it depends on the project type. But I think before looking into the details, if your project type is already commonplace and you can see there's a lot of commercial investment happening there, it's already an indication that it might be difficult for you to make that additionality argument in the first place. And there could, of course, be regional or other factors that make your project less profitable than an average project in the category. But that's kind of one of the first things to look at before really jumping into this process and looking into the details.
Maybe just to add to Simon, so as a developer, it's also important how the project revenue stream is structured. So if it is solely dependent on carbon credits, then it's important there is a pre-screening done at the early stage before efforts are being put. So that is very important when it comes to additionality. But if it is an additional stream, then again the pre-screening is important, but it is not so critical.
Great, thanks. Then maybe another question for Szymon here. Can I buy carbon credits years ahead for my future emissions? And if yes, how can I do so?
You can. So what I showed, for instance, in one of the earlier slides at the start is historical issuance rates. So these are all carbon credits that have been actually verified and issued and are recorded in the registry. But a lot of the buyers, especially in the last few years, because they've been anticipating, growing interest in the market, and the prices are still considered by investors to be low, or where then they engage in so-called forward purchase agreements. So essentially, you either engage with a project developer that has not yet issued any carbon credits, or maybe has issued once or twice, but you offer a fixed or some kind of variable price until, let's say, 2025 or beyond, to secure a certain minimum volume coming from that project. And that really is a strategy that a lot of bigger companies pursue because they want to lock in a certain price. It's a form of hedging. So they're not exposed, every single year to having to go to the market and then see, oh, well, this time it's 15 euros and next year it'll be 25. You can really at least, secure a certain volume of emission reductions that you foresee you will need for the years to come. So that is definitely a possibility, and what a lot of the bigger players and also investors and investment funds have been doing in the market.
Great, thank you. And then I think we have time for one last question. For Satish, where does responsibility stand with regards to carbon projects?
So thank you for the question. So as I mentioned, we are exploring various carbon credits projects. So looking at financing those projects where their revenue stream is through carbon credits. So for us, the approach is not going to be completely different, because what we do currently in our existing climate funds, we do a thorough baselining, and additionality is part of our process, and we also have a stringent ESMS requirements. So what we do in our existing climate finance process is very much similar to what the carbon credits process is happening. But one area why we look at this carbon credits project is it gives additional comfortness that there is a third-party validation and there is a certification. But that won't be the only criteria, because we also have to look at our eligibility criteria, our own additionality perspectives, and then there is so much of reputational aspects also linked to these kind of carbon credit projects. So we'll be looking at various aspects, and then, but we as an organization, we are interested to explore this opportunity directly, where we directly finance, also through our financial institution partners, where we could also support the financial institutions who are partnering with us to help them build their capacity and also help them develop these projects.
Great, thank you.
Thank you very much, Satish. Thank you, Szymon. We're now coming to the end of the webinar. This webinar was made possible with the kind support of the donors from our Responsibility Managed Climate Fund Technical Assistant Facilities. Thanks again, Satish and Szymon, and thank you all for joining. For upcoming events, follow us on LinkedIn. Enjoy the rest of your day. Bye-bye.
Thank you all. Thanks for joining. Thank you, Szymon. Thank you.